In January 2020, an anonymous 89-page report landed in inboxes across Wall Street. It claimed one of China's fastest-growing companies, a $12 billion stock market darling, was a complete fraud. 3 months later, it was delisted. This is how they got away with it for 2 years. In 2017, Charles Liu had a vision. China was the fastest-growing coffee market in the world, but Starbucks dominated. Liu saw an opening, mobile ordering, aggressive discounts, and thousands of small stores in office buildings and residential areas. Luckin Coffee launched with a simple pitch. Order on your phone. Pick up in 2 minutes. Half the price of Starbucks. No seating, no baristas making small talk, just fast, cheap coffee delivered to China's growing middle class. The model worked. In 18 months, Luckin opened more than 2,300 stores across 28 cities. Growth was explosive. By early 2019, the company was processing 17 million transactions per quarter and burning through hundreds of millions in venture capital. In May 2019, Luckin Coffee went public on the Nasdaq at a valuation of $4 billion. 6 months later, that number hit $12 billion. Analysts called it the Starbucks killer. Investors poured in. Everything looked perfect. But behind the scenes, the numbers were already fake. The fraud began in April 2019, 1 month before the IPO. According to the SEC complaint, Luckin executives fabricated more than $300 million in sales using a simple but effective scheme. Here's how it worked. The company created shell companies and hired third-party contractors with ties to employees. These fake buyers would place thousands of orders through Luckin's app. The orders looked real: mobile transactions, proper timestamps, credit card payments. But the buyers were controlled by Luckin insiders. The fake sales inflated revenue by 45%. Quarter after quarter, executives reported explosive growth to investors. The stock soared. Bonuses were paid. No one inside questioned the numbers. But the fraud wasn't just about revenue. Luckin also inflated expenses to match the fake sales. Advertising costs, supplier payments, store build-outs, all fabricated. The company reported spending $150 million on ads that never ran and purchasing coffee beans that were never delivered. Chief Operating Officer Jenny Chen oversaw the scheme. She controlled the fake transaction network and personally approved fraudulent invoices. CEO Charles Liu and CFO Reinout Sharkle signed off on quarterly filings that they knew were false. By the end of 2019, nearly half of Luckin's reported sales, 2.2 billion yuan, were completely fabricated. Investors had no idea. Auditors didn't catch it. The fraud was hidden in plain sight. On January 31, 2020, an anonymous 89-page report appeared online. It was posted by an unknown researcher but amplified by Muddy Waters Research, a firm famous for exposing Chinese corporate fraud. The report was devastating. It included videos of empty Luckin stores. Receipts showing stores reporting 1,000 orders per day but only serving a fraction of that. Employee interviews describing fake transaction schemes. Granular data on store traffic that didn't match reported sales. The author had conducted undercover surveillance at 45 Luckin locations across 10 cities. The conclusion was clear: Luckin Coffee was fabricating at least 50% of its revenue. The stock dropped 10% in a single day. Luckin denied everything. Management called the report misleading and unsubstantiated. Investors were nervous, but many held on. After all, the company had passed multiple audits. Surely the numbers were real. But inside Luckin, executives knew the truth. Within days of the report's release, the board of directors launched an internal investigation. On February 2, trading was briefly halted pending news. The company said it was routine. It wasn't. For 2 months, Luckin stayed silent while lawyers and forensic accountants dug through the company's records. Employees were interviewed. Bank records were subpoenaed. Third-party contractors were tracked down. The fraud was coming apart. On April 2, 2020, Luckin Coffee admitted to fraud. The company announced that Chief Operating Officer Jenny Chen and several employees had fabricated approximately $310 million in sales. The admission was buried in a regulatory filing, but the impact was immediate. The stock crashed 75% in a single day. Trading was halted. Lawsuits piled up. Investors who had bought at $50 per share watched their holdings collapse to under $2 overnight. On May 12, Luckin fired CEO Charles Liu and COO Jenny Chen. But it was too late. On May 15, the Nasdaq issued a delisting notice. By June 29, Luckin Coffee was officially removed from the exchange, just 13 months after its IPO. The fallout was swift. Creditors froze assets. Bondholders demanded repayment. Chinese regulators launched their own investigation. Luckin's auditor, Ernst & Young, was fined and suspended from taking new clients in China. In December 2020, the SEC charged Luckin with fraud and fined the company $180 million. The settlement was one of the largest penalties ever imposed on a China-based company. Charles Liu and Jenny Chen were banned from serving as officers of any public company. Today, Luckin Coffee still operates in China under new ownership, but the brand is tainted. The fraud wiped out $10 billion in market value and destroyed trust in Chinese IPOs for years. The Luckin Coffee scandal exposed a fundamental flaw in the modern IPO process: growth at any cost. In 2019, venture capital flooded into Chinese tech companies. Investors rewarded explosive growth, even when it wasn't profitable. Luckin raised billions by promising to disrupt Starbucks, and the market believed it, until the numbers stopped adding up. The fraud worked because everyone wanted it to. Auditors trusted management's internal controls. Investors trusted the auditors. Regulators trusted the system. And executives knew that as long as the stock price rose, no one would ask hard questions. What makes Luckin different from Enron or Theranos is how simple the fraud was. No complex derivatives. No secret technology. Just fake orders placed through a mobile app. The scheme required basic accounting fraud and a willingness to lie, nothing more. The lesson is clear. When a company's entire business model depends on unsustainable growth, scrutinize the numbers. When revenue grows 400% in a year but stores sit empty, ask questions. And when an anonymous report lands on your desk with receipts, videos, and forensic analysis, pay attention. Luckin Coffee was never the Starbucks killer. It was a $12 billion lie that lasted just long. The fallout was immediate and brutal. April 2020 COO Jian Liu resigned, fired. CEO Jenny Chen suspended. Chairman Charles Liu placed on leave. Audit committee members resign. Stock halted on Nasdaq. May 2020 Luckin receives delisting notice from Nasdaq. Class action lawsuits filed by investors. Chinese regulators launch investigation. June 29, 2020 Luckin officially delisted from Nasdaq. Stock that traded at $50 in January now worth $1.38. Company files for bankruptcy protection. December 2020 SEC settlement, Luckin agrees to pay $180 million penalty Company admits to fraud from April 2019 to January 2020. Agrees to implement compliance reforms. But here's what made it worse: Luckin also fabricated expenses to hide the fraud. Remember scheme number 3? The shell companies that bought coupons? Luckin needed to return the money to those companies without raising red flags. So they created fake vendors, companies that supposedly provided products or services to Luckin. These vendors got paid, but delivered nothing. The money just flowed back to the fraudsters. Luckin didn't just lie about revenue. They lied about costs. They fabricated both sides of the income statement. So what went wrong? How does a fraud this big happen at a publicly traded company? Failure number 1, the audit committee Luckin's audit committee was supposed to question unusual transactions. They didn't. They delegated responsibility to management, the same people committing fraud. The SEC complaint noted, the audit committee failed to maintain strong internal controls necessary to ensure reliable financial statements. Failure number 2, internal auditors Internal auditors had access to the real database showing actual transactions. But they never compared it to the fabricated database used for financial reporting. Some internal auditors were complicit, they helped fabricate the numbers. Failure number 3, external auditors, Ernst & Young, EY audited Luckin's 2017 and 2018 financials for the IPO. They didn't audit 2019. But they wrote a private letter to investment banks saying they had no issues with Q1-Q3 2019 performance. That letter was written before the 2019 audit happened. After the fraud was exposed, EY said they spotted irregularities in January 2020 and raised red flags. But by then, Luckin had already raised hundreds of millions from investors. Failure number 4, too fast to be true 17 months from first store to IPO. 2,370 stores in 18 months. Revenue that doubled every quarter. These are red flags. Hypergrowth companies often cut corners. Luckin didn't just cut corners, they invented an entire fake business. Here's where the story gets weird. Luckin Coffee didn't die. In spring 2021, Chinese private equity firm Centurium Capital injected $240 million into the bankrupt company. New management took over. They cleaned house, fired everyone involved in the fraud, implemented new internal controls, hired independent auditors. And they kept the stores open. Turns out, the coffee business itself was real. Luckin had actual stores, real customers, legitimate demand. The fraud was in the numbers not the product. By 2022, Luckin had more stores in China than ever before. By 2023, they expanded to Singapore By 2024, they opened in Hong Kong In 2025, Luckin opened stores in Manhattan including a location on Broadway and 108th Street. Today, Luckin Coffee has over 20,000 stores in China and Southeast Asia. They've overtaken Starbucks as the #1 coffee chain in China by store count, for real this time. The company that committed one of the biggest accounting frauds in recent history is now a thriving business again. So what's the takeaway? Luckin Coffee is proof that even massive fraud doesn't always kill a company if the underlying business is real. But it's also a warning, fast growth without oversight is a recipe for disaster. Investors lost billions. Executives faced criminal charges. The company paid $180 million in penalties. All because leadership prioritized appearing successful over actually being successful. And yet, they survived. If you want to see another fraud where the company didn't survive, watch my video on Theranos next, where fake technology is a lot harder to recover from than fake sales numbers.